Hey
Okay,
everybody,
let's go.
welcome. We're usually very punctual, and Peggy cracks the whip on us to make sure that we start on time. But we got into such a great conversation offline. I said, "Hold on, let's save this for the panel. This is information that everybody would probably want to know." So, welcome. We have a great webinar planned with Dr. Tom Engblom. He's modest. He likes to just be called Tom. I told him if I went to school and got a doctorate, I'd want to be called doctor. But we're just going to call him Tom for this presentation. A few housekeeping rules. There's some buttons on the bottom of your screen. There's a Q&A, and that's for questions. And the reason we want to use that Q&A box is because we can record those questions. We can keep them on file. We can reference them later. If you ask questions in the chat, it gets lost. The chat's just for nice, positive comments, to say hi, to say great job, to say that I look great and I look like I've lost a few pounds and I have a nice tan. Anything like that, you can put in the chat box. But the Q&A, let's keep the questions in the Q&A. I'll either answer those as we go, or I'll save those for the proper time to kind of interrupt Tom. Daniel's going to introduce himself last on this, but he's also going to be part of our panel. And I'll pass it over to Peggy so she can start introducing some of the sponsors.
Okay, awesome. Yes, welcome everybody. Uh, I want to first start with the introduction of, and she's not on. Okay, let's move on to the next one. How about Cameron D. Andres is on. He is with Best Roofing. Cameron, tell us about yourself and what's Best Roofing doing?
How's it going, everybody? My name's Cameron Andres. I do business development with Best Roofing. We're a commercial roofing contractor based in Southeast Florida for the past 48 years, and we're here to help you with any and all things roof related. So we do big construction re-roofs from 40 building condo complexes and high rises down to smaller single family home repairs and re-roofs. So anything like that, anything in between, please let me know. We do also offer complimentary roof audits. So if you want to get somebody out on your roof, give you the life expectancy of your current roof system, to get you a quote for any repairs that need to be done, and get you a cost estimate for what a full re-roof would cost. We'd be happy to do that for you as well. Thank you.
Okay, and I believe y'all do the annual maintenance or semi-annual maintenance contracts and get signed up on that list also because when it hits the fan, Best Roofing will have you on a first come, first served basis and try to get you as fast as possible. So just wanted to add that. I guess the other sponsors, well, here is Siobhan here coming on from United Professional Engineering. You want to do your introduction, Siobhan, please?
Hi, good morning. Yes. Uh, Ciao, everyone. It's Friday. My name is Siobhan Gonzalez. I am the Business Development and Client Relations Manager here at United Professional Engineering. We are a full service structural engineering firm. We've been serving South Florida condominiums for over 21 years now. So we do all things from the roof to the garage, your building recertification, milestone, phase one, phase two, concrete restoration and repair. So we are here to help. Our team is licensed, experienced specifically for condos, mid to high rise. If you have any questions, right now we are doing complimentary proposal consultations. Gives you an opportunity to meet with myself, a member of our engineering team, in person at your site, address your concerns, and help create clarity on the next steps. So if that interests you or you have any questions around engineering or, milestone inspection deadlines for your association, please don't hesitate to reach out to me directly. You'll receive all my information in the sponsor sheet to follow this webinar and also I'll put it in the chat. Thank you so much. Enjoy the webinar and I look forward to talking with you soon.
Okay, awesome. Thank you so much. I do want to mention a couple of the sponsors that are not on today have previous appointments, but you are important to them, so they did sponsor. I want to mention Southwest Elevators. Your contact there is Brooke Cavender. All these people will be on the sponsor sheet that I will send out following this webinar. We also have Dawn Miller from the Paving Lady. They've been around for over 20 years and they have now a new office up in the Orlando area. So between here and our South Florida and Orlando, you can get your estimate from them. Next, we have Hafer Services. Hafer is a full-service CPA firm based out of Palm Beach, Florida. However, they have 4 offices around the state. Your contact there is Nicole Johnson. And with that, I'm going to also have Vinteum Software, which is my one between my wings, introduce themselves. I'll let Laura is on. And Laura, if you'll take it from here.
Absolutely. Thank you very much for that introduction, Peggy. Hi, everyone. My name is Laura. I am the sales executive here at Vinteum. So here at Vinteum, what we do is that we work with communities, whether it's a condominium, HOA, and also with property managers and property management companies. We help them create the website for the communities. We also build the residence portal for them where you guys can have a full all-in-one system where you can communicate with your residents, where you can set up your board meetings, have your e-voting process, have a better organization when it comes to service requests and also for incidents or violations, however you want to call it. Basically, as I said, an all-in-one platform where you can easily manage and have full control of your community, whether you're a self-managed community or if you have already a property management company. For those who haven't tried our services, we have a really nice recent product that we just launched a few weeks ago, and it's our Neighbors Lite version. So what is this about? We're giving you the chance to have a completely free website and portal yes, and as I mentioned, it's for free. You guys can go ahead and take a look at it in the link and the information that we're going to be sharing right now through the chat. And you can take a look. You can just, set up your community right there. If you have any questions, you can definitely reach me out personally. I'll be super on top of any of your questions. And you can, take a look to our Neighbors Lite version and see how great our product is. We also provide full support, training as well for your board members and for your property manager. So if you guys have not yet acquired any website or portal, or if you guys would like to try out a different provider, this is a chance to do it. So thank you very much, guys.
Okay, and with that, I'm just going to turn it over now to Daniel Baum. Daniel, you are on the panel today, and I would like you to introduce yourself and tell us what you do and how that relates to construction, please.
Sure. Good morning, Peggy. Good morning, everyone. Thanks for having me. So I'm Daniel Baum. I'm the founder of COA Solutions of Florida, and we work exclusively with condominiums, homeowners associations, and rental properties, multifamily properties throughout the state. And what we do is we look to help boards and property managers navigate the insurance market and understand their coverages, making better decisions around risks, premiums, deductibles, and of course, long-term planning. With today's topic, specifically when it comes to construction and construction loans, insurance can play a major part. Both the coverages you have, what reserves you have in place, inspections that have been done, and financing to pay for these things are no longer separate conversations. When a community is dealing with concrete restoration, roof replacement, maybe even more importantly, structural repairs, and a construction loan might come into place, these decisions can directly impact insurability, the premiums you might be paying, claims, lender requirements, of course, and ultimately the financial health of the association. So my goal today is to help connect the dots from the insurance side so boards and managers can be more proactive, avoid coverage gaps, make sure they're protecting both the building and, of course, the community's financial future.
Thank you. Let's turn it over to Mr. Tom. Mr. Tom, introduce yourself, please, and then you can roll right into your presentation.
Thank you very much. And if they could get the share capability as well, I'll be all set then. My name is Tom Engblom. Been in the industry for a long time. Originally from Illinois, and I used to supervise 20 of the largest buildings in Chicago. So I've seen it all, done it all. been a college professor at university, write books on this, and for the past 23 years, I work for the bank, and I have provided loans and insight and lecturing. So that's the summary where I've been for the past 40 some years.
Guys, before we start the lesson, can I take a screenshot? So everyone we register this moment. So I take a little bit of time to process this photo. So please, everyone, straight up to the camera and with a big smile. Yes, I did it. So let's continue. Thanks.
Tom, are you able to share your screen?
Not yet. Just waiting for it to come out.
Fabricio, does he have the ability to share?
Okay, let me see. Yes, he can share the screen, but if we have some kind of difficulties, I can share for him. No worries. Can you send me the presentation, please?
So it's not allowing what you want me to do with it? Or you want me to log out, log back in?
One sec.
Able to use the screen share on the bottom, Tom?
Yeah, it's just highlighted green, and it won't allow me to.
Okay, let me check on that. One sec. I'm turning you into a co-host right now. One sec. Let me see if you can share. Not yet.
It's showing only hosts on my end.
You're a co-host right now.
Okay. It's still not allowing it to come up.
When you click the green button, it's not giving you options.
Nope, not at all.
Okay, so Tom, why don't you send your slides directly to Fabricio? Fabricio, you can be prompted by Tom.
Okay.
Can you look at the email that you got from him to get your link, Tom?
Yeah, hold on.
Everybody bear with us as we navigate through this little hiccup. Grab yourself a cup of coffee. At 10:15, it might be your second or third cup, but that's okay. You're going to need the energy. Or
Maybe
finish solitaire or check your emails.
We could field some questions from the audience into the chat box, what you would like to be answered regarding construction. If anybody has a construction project going on,
Yeah,
you
any
can bring it
questions
up.
at all regarding your building's current situation, loans, insurance, construction. If you guys are going through something now and you have a question, what excited you and what was the reason that you kind of logged on? What were you hoping to learn? Dominic had a nice comment. He looks like he's already using United Professional Engineering. Looks like he has a project going on. So hopefully we can help him after the call. It's not an easy task, and we're very empathetic to what everyone's going through. This isn't easy waters to navigate, and that's why we do these. We want to make sure that everyone's educated as much as possible.
Yeah, and to your point, Rudy, if I may, I think that one really important step that I've seen in this process as, board members and property managers and associations are, knowing that they have an issue at their association going on, they have an upcoming project. And I'd love to hear your take on this while we're in this interim time. They're not really sure about what they need, right? So then, of course, like that's where the professionals come in. And I think one really crucial step is that first step is so important of really identifying the scope of work.
Yeah.
Like what does the association need? And I really, just yesterday we were down in Brickell, and the association called us and they have XYZ, and we go there, and yes, they had XYZ, but there was a really big ABC.
Yeah.
And so just I would love to hear from you and see what's your take on really that first step of identifying the scope and knowing what needs to be done here.
Yeah, and the engineers have done a great job, especially the ones that we work with. There's a few that are best of breed. There's a few that just came in out of nowhere that might not have the experience. So it's really important to pick an engineer that has been in this industry and been in this part of the country and has a track record. And they can do the best that they can to try to identify what is wrong with the building. But that's just looking at the shell, and that's a visual observation. And once we start getting into the construction, things are going to pop up. But a good engineer that has been through this, they're going to know what's going to pop up. So they're going to understand that we might have went with A, B, and C, but D, E, and F. And they can really hopefully forecast that scope of work and the budget to meet that. But before that started, me and Daniel have talked a million times about this, and we've had some, law firms on here, and we've had, other people involved. You really need to get everybody involved. It's just not with the engineer and the association. You need to get your bank involved. You need to get your insurance involved. You need to make sure that you have everybody involved because everybody kind of ties in to one another. So before that project is started, you got to make sure that you're reaching out to everybody that is involved with your building to make sure that you have the right coverage, to make sure that you might need a builder's risk policy, to make sure that your renewal is not going on right when you're doing this construction project. Unfortunately, the bulk of our work is done during the summer, and that's because that's when everybody's gone for the summer. The snowbirds come back. So we're doing the bulk of our work during rainy season. In a perfect world, we'd love to start all of our projects in September and October and November, December when it's not raining, but people want to get the work done. And some policies or some boards, papers, their docs are written that, no major construction can happen during the, winter months and the fall months or even the spring months. It's always, during the summer. So you got to make sure that you're protected. You got to get with your bank. You got to get with your insurance advisor. And you got to make sure that you got to have all your ducks in a row. And a good engineer will help you lead through that. And hopefully, you're working with somebody like Daniel that can talk about your insurance and your policy and a builder's risk policy if you need it. And then a good bank like, Tom's, and, he can help you if you need financing for this. A lot of times people don't have the reserves built up and they don't want to do a huge assessment. A loan is a very great option to have that really kind of lessens the blow financially. You just got to make sure that you get everybody in the room or on the email or on the phone to make sure that you got all your ducks in a row before a project is started.
You bring up, I'm sorry, you bring up an excellent point, Rudy, and something that everyone should consider. That, many times that when I go through this process or an association, a board, they're always trying to be frugal. And what they're looking at is how long should this project take? For example, we're going to do re-roofing and we're going to do it in phases, and it's going to take us 3 to 5 years. Well, what they don't realize is it's going to cost them more money if they go about that approach, because I'm sure you could probably say that if an association buys material in bulk, they get a discount.
Yep.
And it's all, inflation is always going to continue, cost is always going to continue. So the true benefit that they have is to get a bank loan, knock it out, and get it done in a short time. Or I've even heard individuals say that they have the particular company cannot do the work, in that period of time. They're not large enough. Well, you have the wrong company then, in my opinion.
That's a great point, Tom. We're a great company, but if somebody said, "Hey, we got $1 million project and we want to start next month," I would be honest and I'd say, "You know what? We're not the right company for you right now." So, my sister always said, I'm like, "Hey, you met the right guy." Well, I met the right guy, but it's not in the right time, or it's not the right time for the right guy. Get used to my horrible analogies because I have a lot of them. But yeah, you have to really ask, what is your schedule like? How many people do you have? How many projects do you have going on right now? And if they have 15 projects going on when yours has started, do they have the bandwidth for that? Or are they going to bring in their B or their C workmanship? Are they going to hire subs? So on and so forth. So it's not only is it the right company, but is it the right time for that company to do that work? That's not a question that's asked. And I think that's a great point. It looks like we have the slides up. These are great conversations. We already got some great questions. I'm going to get to those questions. Let's start the presentation. And Tom's not going to wait to the end to ask the questions. We're going to kind of work those questions in. It's going to be a little bit interactive. So Tom, I'll let you go ahead and get started.
All right. Thank you very much. Sorry for delay. We'll get through it. We'll make it interesting. And as Rudy said, ask questions because honestly, I like providing a lot of humor and stuff, but talking about bank loans is a very, very boring subject. But if you go to the next slide, what I want to kind of tell you about is being a university professor, educator, whatnot. I talk about Akeem's razor. And what this is all about is it's about making everything simple. Don't make it complicated. Ask questions, go through. You see a couple analogies there that they give about losing your keys. Did you really misplace them, or did you have a ghost come and take it? So make this simple. Don't make it complicated. At the end of the day, the presentation, we're going to have you full of knowledge to make you understand very simply about association loans. They're not that complicated at all. In the next slide, I'll just give you an overview again about what we're going through. And if you click through it, it'll give you 3 different areas there that you should see. And why are you doing a loan? Well, with associations, and again, coming from the Midwest, I was always taught and trained to constantly reserve. And fortunately, in many associations, they don't want to reserve. They don't want to put the money away. And they kind of call that the green banana theory, that you don't keep bananas that long. So why do I care that I live at that association? I'm not going to be here in 10 years. I don't need to put money away. And fortunately, because of that, that's one of the reasons why I have a job today. Now, if you click it 2 more times, 2 more headings will come up. There you go. Now, one of the things that you have to remember, what I'm telling you is just my example working for the organization that I do. Although I want you to work with First Citizens, there's many, many other banks out there. In fact, when I started years ago, there were probably only 5 association banks that were out there. Today, there's over 25. But what makes it unique is some of the banks don't understand how to do loans. And in our situation, because of our background, our knowledge, our expertise, this is one of our fortes that we do. And we, last year, we closed over $400 million in association loans. So we have the knowledge, the expertise, and everything. If you go to the next slide, we'll get into some of one more. There we go. Why do you need this? Why do you have it? Well, various reasons. Is it structural, as Rudy said before? Is it something that you've had an insurance claim? Is it curb appeal? What is it? And fortunately, and I didn't share with everyone either, not only have I been doing this for a long time, but I live in Panama City Beach, Florida, and I became board president. I don't know why, but I became board president of a high rise in Panama City Beach, 23-story. And I can tell you, the board president, all the different components that go on with Florida. And I must salute everyone that's an association manager in Florida. You are ahead of the curve in the industry compared for your knowledge, your expertise, and what you have. And I travel the country and lecture, so I've been in every state and seen it. But why do you get a loan? Well, it's real simple. The costs, the efficiency, the productivity. Is it going to make the homeowners happier? Is it going to make the association go up in value? What are the different components that you're going to have? And we kind of alluded to it a little bit before about knocking the work out, getting it done very quickly, very efficiently. If you go to the next slide, we're going to get into some of the other components that you have. Does the particular company have the skill set? What are the requirements that they have? Can that company cover, as Rudy said? What is the repayment structure? How are you going to deal with it? And the greatest component that you could deal with is always surround yourself with good companies. So whether it's an attorney, a CPA, the elevator company, and the list goes on and on. They're all very, very important, and they all work together. And I can tell you, typically, when I give a presentation to an association, the board, and you educate them and you show them the components of getting a loan, the efficiency and the aspects, it will make a huge difference for them to be more efficient and productive to accomplish their goal. If you
Tom,
go to the next,
we
go on.
had Becky make a comment that she's looking for a line of credit to start some modernization of elevators. Now, a line of credit is different than a loan. So I know it's all situational, but in Becky's situation, would a line of credit be different than a loan? Would a loan be different than a line of credit? So I want to make sure that she's using the right terminology, or she's getting her solution solved, but it might not be a line of credit, it might be a loan. So what are the difference between a line of credit and a loan, especially in Becky's case where they're looking to redo their elevators?
Excellent question. That's something that we'll talk about. But the summary that I'll give you in our situation, a line of credit is nothing more. And people confuse a line of credit with what they call a draw period. Okay. So in our situation, in our bank, we give you a line of credit and we will give you up to $1,000 per unit. The negativity of that line of credit is that the interest rate is going to be much higher. Whereas if you get a loan, you can have what they call a draw period. And during that draw period, you can pay interest only. So let's just say she gets a loan for $5 million. She can turn around and, depending on how they amortize that, which is another name for the term, they can have a draw period for up to a year or 2 years where they pay interest only.
So would a line of credit be a better option for a property just to always have a line of credit, like a credit card for like emergencies? Sounds like it's a little bit of a higher interest rate. I know for my business, we don't have any debt in our business, but we do have a line of credit. And that line of credit is for emergencies. Does a great piece of equipment come up that we want to purchase? Do we need a loan for anything? We've never used the line of credit, but I always want that there just in case we need to use it. Is it the same for a condo? They should use it for a line of credit. Maybe a storm comes through and they need a loan, but they don't want to use the paperwork. I know that I have people in the landscape business that sand gets poured onto the pool deck and they have to hire their landscaper to come in with a bobcat and usually, shovel it away. They don't have the cash readily available. They would use their line of credit for that. So is a line of credit more for like emergencies opposed to CapEx projects?
It's more emergencies than anything else. It's that you didn't budget. For example, where I'm board president, our budget is very, very tight. So if we have something that goes awry in the operating aspect of it, where are we going to get the money? Well, you're going to take it from reserves, which you really shouldn't. So in this particular scenario, that line of credit would be perfect for that.
All right, Becky, it sounds like you should reach out to Tom after this call, but I hope that gave you a little bit of a clarity on your elevator mod and a line of credit opposed to a loan.
And we're going to go through this. So if you go to the next slide, All right. What a lot of people get hung up on, and I'm going to again, this is the educator coming into me for a minute to try to give everyone some of this may be redundant to people, but I wanted to give you the basic foundation so you know the lingo and the terminology when you get into a bank loan. So the loan term is nothing more than the length of the loan that you get into. And again, every bank is going to be different depending on their situation. In our situation, our range is from 5 to 15 years, depending on the type of rate that you're going to get. When you get into the interest rate, how do they calculate it? Well, the interest rate is what they're going to charge on the loan. And again, depending if you have a draw period or not. Well, how do they come up with that interest rate? Well, as you can see there, typically banks borrow against what they call or base it on what they call the Fed fund rate. And the Fed fund rate is where banks can loan money, they send it overnight, etc. So typically what will happen is depending on that rate of what the Fed fund rate is, the bank will put what they call a spread onto it. And if you go to the next slide, I give a very simple explanation of the spread there. So when I was preparing this yesterday, the Fed fund rate was 3.75. So a bank may add 2% to that. And that's the cost that they're going to make based on what they have out there. And that's how they're making their money. Now, the principal is you really have two components. And remember, a loan is nothing more than a scale, the scale of justice, if you picture that, where it's going back and forth like this. And essentially, if you get a loan, your first payment may be, if your payment's $5,000, your first payment may be $4,999 on interest and $1 on principal. And every time you make a payment, the interest goes down and the principal, what you're paying to that total cost, is going to go up. So in theory, when you take a loan, regardless of the term, say 10 years, half of that is going to be paying interest only. When you hit that 5-year benchmark, then you're going to be paying more to principal than you are to the interest. Loan origination fee is just basically points, and what they do is they may charge you a quarter of a point to prepare the documents. So if you get $1 million loan, they're going to charge you $2,500 for that. Okay. And this is it, and it's basically the same whether you get a personal loan for a house or if you get a loan for an association. All the banks are going to vary, they're going to have different fees. So these are components that you want to look at. Now, just because one bank may have a higher interest rate doesn't necessarily mean that that's a negative component, because remember, you can always pay more on that loan. And what happens to that additional principal is that it goes directly towards that balance. And what is interest calculated on? It's calculated on the balance. And I can show you or tell you, for example, if you get a 10-year loan with us, statistically, you're going to pay it off in 7. Loans of this type never go to term because associations want to get it off their books. So then another component that they can charge you for is loan documentation fee. So they're going to prepare the legal documents. They may charge you $500. They may charge you $1,000. Again, every other bank is different. Now, the big component that you have in this scenario is collateral. So remember that there's 2 types of loans out there that you can have. You can have an unsecured loan, which is nothing more than a credit card, or you can have a secured loan where you give something of value, your firstborn, the house, the car, whatever you want, right? Well, in an association loan, there's nothing of value that the bank has, with the exception of assessments. So what does that mean? The bank is not going to lien the clubhouse because what are they going to do with it? They can't lien the swimming pool. So what do they go after? They go after the assessments. So the association pledges the assessments as collateral. What does that mean? That means that if the association does not make a payment, the bank has a legal right to come in and get their payment. That's all they want to do. They want to get their payment back. And I can tell you, in 23 years of doing association loans, that's never happened. Why? Because getting a loan with an association is the safest type of loan for any bank to give. Why? Because it would take the entire association not to pay. And what can happen if the association doesn't pay? Well, now the management company, the board, has a right to special assess. So the bank will always get their money. There's no way around that. If you go to the next slide, please.
So, Tom, let me interject. So somebody else said, Yamlet, excuse me if I didn't pronounce that correctly. Her building needs a lot of repairs. The owners are mostly senior, probably on fixed income. They would love to find a program to help them. Are there any programs? Has there been any talk about maybe a state-funded loan program or, some help from the state? Are there any programs? Are there any grants? Is there anything out there where, these individuals that are on fixed income that don't want a huge assessment or don't want a huge loan, are there any programs, are there any government programs out there to help with this legislation and the monetary burden that it's put on people?
There are programs out there. I don't know the name of them off the top of my head, but again, being a board member, I've read the information and I've seen it. But see, this is the advantage about being able to get a loan with an association is that you can tailor the loan based on their fixed income.
Right.
And in fact, when we get to the one product that we offer, we have a loan calculator built into the application. So you plug in the number of units, you plug in what the assessments are, you plug in what the annual special assessment is, if they have it, and the loan calculator will tell you how much you can borrow. And we know based on historical data with that quick term loan product that we can loan up to 25% of the operating budget for the association. And again, one of the things, this is what makes it nice. You can get a loan for $30,000. I just closed on a loan a month ago in Chicago for $40 million. And you can tailor the loan to what your needs are. But there are special programs out there that they have through the state that you can apply for. I know that for a fact.
So Robert just commented that My Safe Florida is available with grants if the association qualifies. So, I think that's for everybody that's looking for some sort of grants or some sort of help. I think My Safe Florida is going to be a fun Google search after this presentation is over. I myself am going to learn more about that because I do have a lot of properties that are, on fixed income and didn't do a great job with their reserves. And so My Safe Florida, I think that's worth a Google search after that. So thank you, Robert, for that. So hope we answered your question. If you have any other questions, please reach out to Tom after this presentation.
And Rudy, there's a lot of companies that my coworkers and I deal with, companies of your type, because they're trying to do the product or project and the association doesn't have the money. So we're able to facilitate and be that conduit with the particular company in the association. So it's all about the bigger picture and helping out. So again, a little bit more about loan terminology, and this goes back to the previous question. Can you have a draw period? The answer is yes. You pay interest during that draw period only. You can pay additional to the principal if you want, or depending on the type of loan, we give you all the money day one. Minimum number of units required by lenders. Again, every lender is different. Our threshold is 25 units or more. Why? It's a mathematical equation. Think about this for a minute. if you have one person or two people with 20 units or less not paying, that puts a financial burden on that association, and that's a concern for the bank. So, based on the numbers and calculations that we've done over the years, our minimum threshold is 25 units. Delinquency rate, our different products that we have, one is 8%, one is 10% of the total number of units 60 days or more. So we know that if you have a 100-unit association and you have more than 8 units that are delinquent, that puts a financial burden on paying that loan back. So that's a red flag. And unless you get that delinquency under that amount, we will not give you a loan. And then the same scenario with another bank. All right, prepayment penalty. Well, sometimes banks charge a prepayment penalty that if you pay the loan off early, because they're based on that model for 10 years or whatever that term is going to be, that they're going to make a certain amount of interest. So if you pay it off early, they want that money up front. And sometimes if you refinance with another bank, they're going to charge you a penalty. So that is just something to consider when you look at the loan documents. Okay, amortization, my Latin background means to kill off slowly. So when you get a loan, they're killing you off slowly with what they're charging you. And remember, it goes back to that explanation that I said, $1 the first month in principal, and then each month it goes more and more. That's going to offset it. A UCC recording, again, going back to the comment that I made, the association has nothing of value that the association or that the bank wants other than the actual assessment. So what do banks do? They record a UCC against the property, and that is not a lien. That does not prevent anyone from selling the property. It just shows for future buyers coming in that there's a loan against that property. Next slide, please. All right, just scroll all the way to the bottom and they'll make it easier. All right, this is one of the products that we have. And again, I've already said it, we're unique in this scenario. So in this particular case, we send you an application, and within that application, it has a loan calculator built in. And you have 10 simple questions that you ask or that you have to respond to. Do you have litigation? And we're not talking a slip and fall. We're talking a major against a developer or something else of that type where we can get into insurance litigation or other components. And the rate is fixed for 10 years. We fund 100% within clothing. And what makes this nice with this application, and it's revolutionary, it's been out since 2016, and other banks have tried to copy it and have been unsuccessful. But within 2 days, you know if you're approved. And within 3 weeks, we fund 100% of the money for you. And you can see minimum 25 units, no origination fee, and a one-time fee of $500 prior to closing. And it goes up to $3 million. And with this loan, again, you have 5, 7, or 10 years. So I always tell everyone to go with the 10-year period because the rate is minimal between the 7 or the 5, and it will qualify you for the most. So you need, in the particular case of the individual that needed a loan for the elevator, this would be perfect for her. Boom, fill it out. 2 days, she would know. She gets 100% of the money. Now, some people may say, well, we're not going to use all the money for 6 months. Okay, pay out what you need and put the rest in a CD or money market, because you can get a CD right now. We have a 90-day CD for 4%. The interest rate is 6.25 on this, So it's only costing you 2.25 for interest for that 90 days. Just a way of cash management. If you go to the next slide and go all the way to the bottom again, just scroll through it, make it simple. All right, this is our standard loan. And in this particular case, we'll go up to 25 million. When we did the loan in Chicago, that was 40 million. So we gave them two separate loans to be able to bridge that gap. Now, most banks don't have the financial capability of going above 10 million. We do because of the size of our bank. But again, if you look, you get a 5, a 7, a 10, and 15 year. Now, in this situation, it's not a straight 15-year loan. What we do is we give you what they call a 10-5. So you're fixed for 10 years. At the end of 10 years, you basically have a balloon that comes due. If you don't pay that balloon, then you have another 5 years that you pay. Now, one caveat about that is that if you get a draw period, let's say you have a draw period where you pay interest only, and we're going to give that to you for 1 year, we reduce the loan term from 15 years to 14 years. So now you're amortized over that 14-year period. What does that do to your payment? It's going to make it go up. So one of the suggestions that I always have during that draw period, you just don't pay interest. You pay principal and interest. So at the end of that 1 year term, when you get the loan balance, it's reduced and you're saving yourself money. And again, 25 units, origination fee will vary. And the documentation fee, as we talked about before, in this scenario can range between 5 to 5,000. So as you can see, the quick term is the way to go if you can go under 3 million. And then the delinquency is at 10%, not 8%. So if you go to the next slide and go all the way to the bottom again and make it simple for everyone, this is the line of credit, Rudy, that we were talking about. And it's just basically a credit card. That's all it is. And we're going to give you $1,000 per unit. The max that you're going to get is going to be 250,000. You can see, what are we basing on? We're basing on Wall Street Journal Prime. So the interest rate's going to be high. It's going to be 12, 14%. And remember, you got to pay it just like a credit card, and you're going to pay fees. So I would suggest, before I would get the revolving line of credit, that I would get the quick term and knock it out and be done with it. Make it very, very simple. Next slide, please. Life cycle. What do you want to go through? What's the purpose of the loan? How are you going to go through it? So one of the scenarios, what we were talking about before, about delaying the project and making it longer, because I covered so many states for the bank, I had a particular case in Michigan where they were going to do all their roofing. It was a townhome development, and they were going to pave the streets. But they wanted to do it over a 7-year cycle because they didn't want to increase the amount of assessments that people had to pay. If they were going to go that route, it was going to cost them $2.2 million total cost. Because they were able to get a loan, it only cost them 1.7, and that included interest. So it's about a time management issue. And again, if you use our quick term, if you fit in that box, you're good to go. If you go with the standard loan, that's where it gets into underwriting, and they start looking at your delinquency. They start looking at your reserve study. They want to make sure that you're funded in the future. What is going to happen? And again, documentation. Does the board have the authority to do this? The first question that I will ask anyone if they come to me and say, well, we need a loan, my first question is, have you read your documents? Does the board have the authority to get a loan, or do they need to get the unit owner membership? That's important because we, as a financial institution, we want to make sure that the board, that the management company is following the process and going through the due diligence that they're supposed to. You go to the next slide. Again, what is the collateral? You're giving your assessments to it. As a board member, this question comes up all the time, all the time. If I get a loan and I'm the board president, am I personally liable? And everyone should scream out, no. Why? Because it's a corporation. You're an officer of the corporation. Well, what happens if I sell my unit? It doesn't matter. The loan has been closed. You agreed to it. You followed the due diligence. Well, what happens if my neighbor doesn't pay their portion of the well, they're not paying a portion of the loan, they're paying a portion of their assessments. What happens today? You turn them into the attorney. It just depends. You follow your due diligence. Because one comment that I didn't make, think about this scenario for a minute. Your association, pick whatever dollar amount you need, $100,000. Well, is it better or more challenging to go to that unit owner and say, write me a check for $5,000? How many people have 5 or 10 or 15 or $20,000 that they can write a check? Whereas if you get a association loan, now you're taking that dollar amount and dividing by 10 years. 120 payments. It's much more conducive to follow that process. Now, one of the items that I want to personally tell you is when those unit owners, if you have a special assessment, you typically give them a choice. And you say, write me a check for 10 grand by June 1st. If you don't have it, we're going to take that $10,000 and divide it into 120 payments. And then we're going to charge you interest based on what the bank is going to charge. So that'll cost them probably anywhere from $10 to $15 a month in interest. Well, now the board has a choice. They can turn around and say, if you sell your unit, that's negotiable between the buyer and seller. We're not concerned about that. But the way that I like to approach it, I would say if you sell your unit, you have to pay the balance of that special assessment today. Why? Because what the association can do, and typically in most associations, they have a 10% turnover ratio of selling. What will happen is you take that money, you call me up and say, Tom, we got $40,000. We want to put it on the balance of the loan, and we want you to recast or recalculate the loan. So what does that do? That makes the payment go down. That makes the interest less for the association. That's why, as I previously stated, you're going to have you're going to pay it off in 3/4 of the term. You're not going to cover the full length of the loan. Okay, what happens if the association is in litigation? It really depends on the type of litigation that you're in. And that's where you have your counsel and insurance get involved. Delinquency matters, as we talked about before. And if you want to go to the next slide. All right, top 10 reasons. And we can go through these really quick. If you go to the next slide, please. Why can't you get a loan? Well, the official documents are incomplete. Maybe the articles of incorporation are not filed. Maybe you didn't have the amendment. Maybe the UCC that we talked about is not in good standing. And just the regress for a minute, one of the components that always make me smile, not only do we do loans, but obviously we do lockbox, we do credit cards, we do things of that. So we'll have an existing management company take over a client from another management company or association. And what will happen is we have to do our due diligence, and the TIN number, tax identification number, for that association may be incorrect. And it's been that way for a minimum of 10 years or so. Always amazing. You got to go 2 more slides for pending litigation. There you go. So again, we talked about this a little bit. What if you have a construction defect? Well, you're suing the developer for a certain reason. Contingency are not there. Legal fees are not covered by insurance. These are all reasons why you could have pending or future litigation that may not be part that provide the association a loan. Next slide, please. Rudy alluded to this during our conversation. The companies are too small. They don't have the bandwidth. They don't have the knowledge. They don't have the expertise. And when you get into a certain type of project, and I want to tell you my personal thought. And I said this in the beginning. I always surround myself with good people. So being a board president, I'm not going to sign any contract unless the attorney looks at it. I'm not going to, here's a great example. Someone said that they're going to do elevators, and I've done over a dozen mods for up to $5 million in elevators. I know a lot about elevators, but what do? I hire an elevator consultant. Make sure you got your ducks in a row. And that way, think about it. We're going to have an insurance person on here. It's having a consultant is nothing more than having an insurance policy, because it's going to be done right. And think about the efficiency that you're going to have if you're going to do a roofing project and you have a roof consultant or an expert come out. And it's going to make it so much easier for the attorney to go through the process, the bank to give a bank loan. It's very, very simple to go through the process. That's what you want to do. Next slide.
I couldn't agree with you more, Tom. Dominic made a point here. He says, communication is a key element in transparency. It's vital, especially in today's market. If you're dealing with a contractor and it's a big project, right, and it should require a permit. If you ever say, I need to contact my attorney, or, I need to, let's ask the engineer, or, let me call my insurance guy. Let me make sure that this is good. If they say, oh, no, you don't need those. Any contractor that's worth anything is going to say, yeah, we champion anybody helping with this project, whether it's, in regards to the loan. Hey, Rudy, we need a lot of information for the loan. Can you give us, whatever documents are needed? Here you go. Oh, you don't need to get those people involved. Hey, the engineer, just go ahead and do it. No, let's get the engineer involved. It's the right way to do things, and it's going to free you up of liability. Because if you're a board member, you're a unit owner, you just say, just go ahead and do it. No, there has to be a paper trail. There has to be everybody involved. You don't ever want to sign a document with that, especially that's, hundreds of thousands of dollars, even $10,000 or $20,000 without your lawyer looking at it. Bringing your insurance, your insurance agent, bring it down, and say, hey, we're starting a roof project. Is there anything we need to know? Yeah. Do they have builder's risk? Oh, in the middle of your insurance policy, there's a renewal and you're going to have your roof opening. Is that going to affect anything? And we'll talk to Daniel about that later. So, make sure that you're dealing with the best of breed of companies, and make sure that you're bringing everybody in. And any good contractor is going to champion other people getting involved, because it is part of the process.
Thank you. Very, very good point. And personally, again, we're on board president. We just went out for landscaping bid. And the company that we voted on to proceed with, they sent the contract, and honestly, I missed it. And I sent it to our attorney. And basically, if we would cancel the next day, we would be liable to pay them through the remainder of that contract, which was for 3 years. and the attorney was adamant, take this out, take it out. And that particular company said, no, we're not going to do it. So we went to the next company. But it's something so simple as that you want to have the protection. And very, very important. Reserve study. Now, this is where we get into, again, my bank, the bank I work for is a little bit different compared to other banks, and there's a lot of great other banks out there. In our case, if we do a quick term, we don't look at the reserve study because you fit into that box that we offer you. If you get into a standard loan, then we're going to look at the reserve study. And why? Because we don't want you to be blindsided. We want to know that how are you going to be able to pay that loan off and fund for future repairs down the road. And the fortunate thing that I will say, we have a lot of repeat business. So they'll get a loan for $1 million. They'll do an amount of work. They'll pay on for 7 years. And all of a sudden they'll say, oh, we need to do this work. So they come back again. And we can either combine the loans or keep them separate. Every situation is going to be different. Next slide, please. Term and a loan. So think about this for a minute. If you're going to do a painting project, we're not going to give you a term for 15 years. There's no way. If you're going to do an asphalt project, we're not going to do it for 15 years. We'll do it for 10 years, but we're not going to do it for that term alone because of the life expectancy of that particular product. And that's why the reserve study kind of correlates to it. And we know based on analysis and statistics the life expectancy. And one thing that I will say that to me is shocking, you're probably used to it being in Florida, but the life expectancy of components here is half of what it is in the Midwest. I mean, I'm just blown away because of the corrosion, the salt, the air, and the other aspect of it. Next slide, please. So think about this for a minute. Can they afford it? Everyone knows on this call, you know your population of the association. Can they afford $200 a month more? Can they afford $500 a month more? And the other component is it has to equate to the value of the unit. So in that scenario that I told you that I did a $40 million loan in Chicago, it was a big property. It was 500 units. The average value of the property there was $650,000. So what if they tried to get that and the value of the unit was $150,000? We're not going to give them a loan for that amount. Why? Because a owner could walk away and say, I'm not going to pay that special assessment. So it's really what it's about. But again, going back to trying to get a loan, the benefits of getting a loan outweigh the benefits of not, because you're not kicking the can down the road. You're not putting yourself in liability. You're improving the property. And buyers are becoming more and more sophisticated, and they know if they go to this property, look at how well it's maintained. Yes, we're paying a little bit more in assessments or maybe a special is going on, but look, they have a new roof, they have a new elevator, they have membranes put on the walkway, the pool was sandblasted. The list can go on to how you can compare this to. Next slide, please. Burden, again, too much. They can't afford it. They can't deal with it. Skin in the game. I did a loan one time in Minnesota for 53 units. They wanted $6 million. They were going to double the value of the units by doing all the work that they were going to do with this property. They basically were rebuilding the entire property minus just the framework of the association. The bank said, we're not going to give you 6 million because people can walk away. If you come up with half of that, 3 million, we'll give you the other 3. And sure enough, people were able to write checks, come up with the money, and able to pay for the process before we gave them the $3 million. Next slide, please. This is a big component. If, again, depending on the situation, depending on the type of loan that you have, it will vary based on the number of units that an individual owns. So with our quick term, we really don't address it. With the standard loan, we don't want it to be more than 40% that has more than multi-unit owners. Why? Because it goes back to the same scenario. They could walk away. They could not pay. The other component is, what if it's still owned by the developer? That's a red flag to the bank. They don't want to loan money because banks are conservative. They want to make sure that everything goes through the process. They can get their money. They can go through efficiencies and make sure that everything is streamlined so they can get their money. Next. High rate of investors. Again, how many people own? Think about where I'm at. I'm in Panama City Beach. We have 193 owners. 150 of them are short-term rentals. How do you think that would be handled with trying to get a bank loan? Why? Because they want to make sure that the payments are there. Now, in that case, they'd have to get special writers and treatments and etc. and look at the delinquency. And our delinquency is practically 0. So we would be a good candidate for that. Next slide, please. Past due, we've already talked about this several times. The bank knows, depending on the type of product that you get, what the delinquency is. Now, we're not talking if there's a violation, we're not talking a late charge, we're talking about true delinquencies. And it's 8% or 10% of the total number of units, 60 days or more. How are you going to collect it? And again, I've been doing this for a long time. Only one time did I have an issue with an association. And basically, the bank checks on this once a year because we do our due diligence. But we know if a particular association, if their delinquency spikes, why is there a reason because of that? Maybe a new board, maybe they changed their collection policy, maybe they had an increase in assessments, but it's something to monitor. But once you get through the initial closing, you're good through the process for some time. All right, next slide, please. Okay.
Hold on, Tom.
Yeah.
There's a lot of reasons that you can not give somebody a loan, right? I mean, how many loans? I'm just talking as a consumer and somebody who, owns condos and, someone who knows a lot of people that are living in condos, especially, a lot of people on fixed income. There's a lot of reasons that a loan can be denied. How often does this happen?
It depends on the situation. It really does.
Now, if somebody's looking to get a new roof and you go through this criteria and they, maybe they have a lot of renters, maybe they have some delinquencies, maybe they're in some litigation and they're denied. What's their second option? Do they even have one?
Well, no, the second option is we won't officially give you a denial. What we do is we look at all the documentation. We'll say, because of your delinquency, you're not going to be approved. So you come back to us in 60 days and then reapply. Or You have an issue with litigation, get that resolved and come back. We try to work with the people as much as we can to try to get that loan closed and be efficient. We're a relationship bank. We're
Right.
trying to get as much as we can. But again, what's very, very unique about the division that I work in, we have zero issues with our association loans because we're doing our due diligence. We know what we have to get through, or what we have to acquire from the associations to get through the process and make sure it's efficient and done.
I'm
And
talking
see,
to the rest of my board members, and we need a new roof. Okay, well, it's May. Let's get it done before rainy season. All right, let's go get a loan. How long does this process take? By the time I call you and I say, hey, we need a loan, we need $1 million, we need a new roof. How long does that process take usually before that money's in our account and we're ready to go to contract with a roofer?
well, the quick term loan from start to finish, you can have the money in 3 weeks.
Okay.
If you go with the standard loan will take you double that. Now, for clarity, here's a good example. With the quick term loan, it's all based on the number of units and what their assessments are. And at a certain point, even if they special assess, it will max them out and not give them any more. So there's cases that I had one last week, a 35 unit association in Madison, Wisconsin needed $800,000. With 35 units, they couldn't get that kind of money. So they had to go to a standard loan, which costs them more money, and it's going to take twice as long. If everything's fine, they can have the money in 6 weeks with a standard loan. With a quick term, they can knock it out in 3 weeks. That's the beauty of the quick term. That's why it's so revolutionary and why so many people go that route. And it doesn't get into the minutia that a standard loan does.
I think that's probably pretty important to be, I mean, there are smaller associations that kind of can't afford, the castles and the first services. They're kind of not, earmarked for properties like that. But some of these larger, facilities, I guess it's important to have a property manager. Do you have like a pre-loan document where people can go to and be like, all right, before I ask for a loan, let me make sure that I have this and this and this and this so they can start preparing that document? Or is the best thing to do is just to call you and you give them that list and say, okay, get back to me in a week because you've got a lot of work to do. Here's all the documents you need. Here's all the checklists, so on and so forth.
Well, we can do it either way. With that quick term, we'll send an application out and it has a calculator built into it and it has the criteria. And again, typically, kind of like the golden rule with banks, they like to kill trees. They want a lot of paperwork. That's the advantage that you have with that quick term. You fill out that calculator, you answer those 10 questions, and then you submit minimum documents. You submit a certificate of insurance, a delinquency, and the articles of incorporation, and you're good to go. Now, one of the things that I failed to mention, and this is I'm going to say it's important, but not overly important. But if everyone remembers, back in 2016, the government came out with a new requirement. And essentially, a board member, doesn't matter which board member, but we typically need two of them to give us their personal information. What personal information is that? Their name, their address, not social security number, and a copy of their driver's license. Why? Because Big Brother wants to know who is in charge of that money. And one of the very first question on there, which always makes me smile, is, Rudy, do you own more than 25% of that association? And the answer is always going to be no. But if you own more than that, then you have to disclose it. And that's the beneficial ownership form. And once in a while, you will get a board member that will say, I don't want to give my personal information. Well, then you're not going to get along. A board member needs to provide that. We don't care which one. We have to follow the federal requirement.
Some people are asking about the quick term slide. If they reach out to you, can you share the slides with them?
Yeah, yeah.
So Carl, if
So,
you reach out to Tom at the end, Peggy's going to send a list of everybody that was on the panel with everyone's contact information. You'll probably still get emails from our marketing team and everyone else's marketing team, but Peggy's going to set out everyone's contact information in one quick snapshot. So if you need to reach out to Tom or me or Daniel, you can do so. All right. Thank you, Tom.
okay. If you go to the next slide, and this is where everyone else is going to get involved. This is FHA requirements, and I have slides that I put together here, and Rudy can chime in if you want to, if you want to start now or wait. Um, you can see basically this is going to be FHA and Fannie Mae requirements, what the new laws go into effect. And what I've seen in the research that I've done so far is that basically, if you're in Florida, you're kind of already adhering to this. And if you go to the next slide, it talks about a reserve study and budget review. But here's what I took out of this most importantly. Starting, depending on when your budget starts, if it starts July 1st, 2026 or January of 27, you have to dedicate 15% to reserves to meet this requirement. And now, like everything else, there's exceptions to this. I didn't put in a formula of how you calculate it, but basically your total revenue and multiply that by 15%. So if you have a reserve study on hand and your SIRS, you should be well within that requirement. But again, in my case, where I'm board president, this doesn't apply to us because we're not Fannie Mae approved. A buyer, these are investment properties, so it depends on the type of property that you manage. If you go to the next slide,
Daniel in. Daniel, if you go back to that, if you can go back to that slide, please. It says, insurance standards, updated guidelines will require communities to have sufficient insurance coverage, including property and liability insurance to protect against various risks. This is aimed at mitigating potential financial losses. I think Florida's already there and they've already been there. I think this is a nationwide, update, but I don't think anyone's ever really been denied a loan because the condo wasn't properly insured. I'm sure that, associations reach out to you for certain documents that they need, but Tom or Daniel, I don't think anyone's been denied a loan. I think these condos are more insured than any condos in the nation.
To answer, I mean, Tom would be better at answering whether or not he's had condos that were denied loans because of insurance issues.
Right.
But I can tell you that while the answer is yes, you're right. Our condominiums are probably better insured than any other place in the country, certainly because of our what we call cat risk or hurricane risk. But that doesn't mean that they're necessarily insured to what the state mandated requirement is for insurance. So, for example, the state requires every 36 months that you get a new appraisal. So if you haven't had a new appraisal done in more than 36 months and you go to apply for a loan, Tom, is that a requirement that the bank asks for, is to see a copy of the latest appraisal?
we don't ask for a copy of the latest appraisal, but we do ask for a certificate of insurance and make sure that the association is insured during that time, and they have to continually update that insurance certificate to us.
Right. So that means that the bank wants to make sure you have insurance, but they're not necessarily looking at the minutia of exactly how much insurance are you covering versus the value or the total replacement cost of the building itself. And if this is starting to make your head spin a little bit, this is where you can just get into like a circular conversation around, well, what does the bank require? Or what does the state require? Or what do we have to require for ourselves? Or what should we be carrying versus what the bank wants us to carry versus what the state wants us to require to carry. So it sounds like the lending side is actually a little bit more lenient actually than the state side of it.
And with this new requirement, the way that I understand it, which I don't think it's an issue, but they have to insure the property for a minimum of 5% of the replacement value. Which now there's a soft market. We were able to get again where I'm at. We were able to insure ours for 2% of the property value, and we had a savings of over $150,000 this year in insurance. So,
Tom, I think what you're referring to is the deductible level.
Right, exactly. Got to be 5% of minimum coverage, 5% deductible property coverage, the new requirement.
But if you haven't had an assessment, how do you know what the true value of that property is? And that's kind of how we got into this insurance problem a few years ago, is that they were insuring units at X amount of dollars, and then they realized, wow, these units are worth a lot more than that. And they kind of raised the bar, and that had a whiplash effect. And that's one reason why everyone's insurance went up, is because everybody was so underinsured. It's interesting that they don't kind of mandate that, assessment to get a truer property value to protect the investment, because they might be going off of a 5% number that was 10 years ago. And every property around me, especially the condos, have gone up substantially in 10 years. So I think, Daniel, that's interesting that, that requirement of that assessment might not be met. It might be something that isn't done or isn't regulated enough.
I don't ever want to say something's not regulated enough.
Right.
But in Florida, someone correct me, but I think the requirement is that you have to have an insurance appraisal every 3 years on your property in Florida.
Say that again, Tom?
No, aren't you required by law to have an insurance appraisal done every 3 years? 3 to 5
years? On a
years?
Condominium, specifically on a condominium. But even what people don't realize is they think that they're helping themselves when they don't get a new appraisal. The reality is that, first off, the carriers aren't stupid. They know what they feel the value of the property is. So if you don't get an appraisal done in 36 months, it doesn't mean that they're not increasing what they deem as the value of the property, and will increase your premium accordingly. Second, it actually could work against you, because to the exact specifics that I just mentioned, would you rather the carrier increase the value of your property based on what they feel it should be raised to, or would you rather an appraiser come in and give you what they feel the appraised value should be, or replacement value should be? Sometimes the appraisal can come in less than what the carrier is coming in at. So it actually could save you money getting an appraisal, not hurt you by getting an appraisal. But yes, to your question, Tom, it's actually statutorily required of condominiums and co-ops, not HOAs, to get a new appraisal every 36 months to make sure that the insurance you're carrying is going to be up to the full replacement value.
Tom, can you elaborate on the changes of the reserve requirement? Because the reserve requirement now is, for the new lending, this is just for Freddie and Fannie. There's other types of loans out there. Can you elaborate a little bit more on what's the new requirement for that change in reserves? And usually that change of reserves is irrelevant to Florida, because if you have a structural integrity reserve study and you have to be, and now we're being, forced or mandated, mandated, not forced, mandated to have a substantial amount of reserves, that doesn't really apply to us, right? So that's more nationwide than it is here. So yeah, there are new reserve requirements. And what are the new reserve requirements for the nation under this?
It's minimum requirement of 15% has to go towards 15% of your annual revenue.
Okay, so your annual revenue from your dues, 15% of that has to be in reserves. Majority of the condos in Florida exceed that 15% with their SERS, right? So it really
Correct.
doesn't apply to us.
Yeah, correct. A reserve study. And again, if again, being a former manager of 20 years, and I say this all the time, I would never supervise or manage a property unless I had a reserve study done. And when I became board president in 2021, very first thing that we did is we got a reserve study. And that's my Bible, and we follow it to the letter of the law. And a good example in my situation, they had no money. They had 300,000 in reserves. Today we have everything done and we have 1.6. Now, yeah, there were a lot of heartaches and stuff because, oh my God, 2 years in a row you increased the budget by 15%. But look at where we're at today. And I mean, I think that's the benchmark that you have to do, you follow. But again, when you look at Fannie Mae and Freddie Mac, what you have to look at, depending on the state, the majority of states out there do not have reserve requirements. Or, for example, I was in Illinois. I still go there. In fact, I'll be there next week. They say adequate reserves. What's adequate? I mean, that's why I originally stated Florida is so far ahead of the curve compared to reserve funding and requirements and what managers need to know. They should be applauded for what they have to go through every day.
I don't think we did it out of good nature. I think because of the hurricanes and because of Surfside, unfortunately, and the new legislation, I don't think we're ahead of the curve because we're cutting edge. I think it was more legislation, but nevertheless, we are ahead of the curve. But when we talk about these construction loans, well, we don't have to get our insurance advisor involved. We have insurance. How many times do you hear that? And Daniel, do they need to call you and say, hey, we're getting ready to start a $4 million concrete restoration, a $2 million roof? And what is your role and what is insurance roles in these construction loans or construction overall?
It's never a bad idea to reach out to your agent before you do any major work in the building. Minor renovations or minor maintenance items, you certainly don't need to. But anything that you're going to do that's a major project for the building, and it's going to cost, hundreds of thousands, if not millions of dollars, it's always worthwhile to double check what exactly your coverages are, what are you protected from, and what is excluded from your policy. And you and I, we started this conversation and we were telling the community here that we were running a little bit late in getting, our presentation going because we got tied up into this conversation about the time of year, where are you with the work that you might be doing, and you had expressed that your biggest months of the year start now, May, June, July, August, September. And I'm always flabbergasted that anyone wants to do major work on their building this time of year, because I would think the last thing you want to do is open up your building, especially for a major roof project or a major concrete restoration during hurricane season. You potentially could expose the building to major risk if we had a catastrophic storm come through that may not be covered on your property policy because it was the damage that is done, they could claim is being done is caused because of the work that's being done to the building during hurricane season. So that's when you want to get into conversations about what's called a builder's risk policy, which I would think most of the people on this call probably don't know very much about. And honestly, we don't write it very often because it's rare that anyone comes to us and even asks us about it. But for those of you who are unfamiliar, a builder's risk policy typically will be carried by the contractor. And may or may not, the community may or may not want to carry their own. What does it cover? It covers the actual work being done while the renovations are in place. So it covers the work itself, not for poor workmanship, but for, let's say, a storm came through, wall construction was going on, and the construction that was being done then had damage to it, and you have to redo the work that was already done. Well, that's what a builder's risk policy would come into play for. It might also cover materials that were lost or damaged during the course of construction. And maybe even more importantly is it could cover and would cover other parts of the structures that did not have renovation that was being done to it, but someone could claim, or the carrier could claim, that the damage to the other parts of the property that were done because of the construction that was going on at the time. So I think a lot of associations will rely on the contractor having that type of insurance in place to protect the association. And I think it's super important that you double check with the contractor to make sure what they are carrying and what they're not. Because if they're not carrying insurance that will protect the community and more so just protect them, which rightfully so, then you should be having the conversation around, is this something we should take ourselves to make sure we protect our community while this construction's going on?
Yep. The rainy season adds a different element. I'm not a roofer. What we do is concrete restoration. We do painting. We do waterproofing. We've never ran into something that has been substantial. Do we have to demobilize and remobilize when there's a storm? Yes. Do we make sure we don't get too far ahead of ourselves? Unfortunately, the summer is our busiest time. In a lot of condo documents, it's written that people don't want major construction during the winter, the fall, the winter, and the spring months. It's to be done during the summer. We had a very mild summer last year. We didn't have any hurricanes, knock on wood, that we're not going to have any. I think it depends on the type of work and the exposure of the building. Roofing, man, I would love to know more about roofing and how they, kind of work around that. Or maybe next call we'll have a roofer on the panel. But yeah, and that's why it's important for your lawyer to review the insurance documents of the contractor, make sure that they are properly covered and they don't have a Mickey Mouse policy, because we've seen that a lot of times. So that's
I've had a community that was in the middle of a major roof replacement, and the contractor who was hired didn't properly secure the roof, and a major rainstorm came through. It wasn't a hurricane, but it was just we all live here. We know these humongous downpours that we get periodically, and they did not secure the roof properly. And a large amount of water came in through the roof and damaged several of the top floor units. And they had to go after the contractor and the contractor's insurance to pay for that, because it's not something that your property or their property policy would respond to, because it's not damage that occurred to the property while the structure was in good order. It's damage that occurred because the contractor opened the roof and did not secure it properly before a major storm come through it. So those are the types of real life situations that happen that you want to make sure you've had those discussions before you let the contractor open your roof up.
We got a few questions in the chat. Yes, this is recorded. It will be available. Peggy will send that out when the recording is uploaded, for lack of a better term. Peggy, do you have your hand up?
Yes, I do. I don't know if this comes into play or how it comes into play, but I know myself, this goes back a few years ago. My former husband and I owned a welder fabrication shop, and from time to time we did have to use outside subcontractors. With that, dealing with like SeaWorld, Costco, Sam's, companies I'd gotten us into, they required, certificate of insurance also. So I always, like every 3-4 months, went back and re-verified that the subcontractors had their insurance still in place. So, getting that up front is one thing, but sometimes the contractors bring in other subcontractors that they rely on. And, I'm sure that umbrella coverage or something is going to hopefully support the general contractor, but still it's good to know, are they still current with their insurance certificate for the individuals involved? Because what if there's an accident, as far as an employee accident or something? So there's all different reasons to re-verify the insurance, I would say quarterly on a project.
Great point. Tom, what do you got?
Well, two components. One, with Peggy, I was always taught to have that company list the association and the management company as an additional insured. That way, if their insurance expires, then you're notified of it. Plus, it lists you against for indemnification. And then, David, with the builder's risk, or Daniel, I'm sorry, with the builder's risk, does that include performance and payment bond, or is that separate policy?
Separate. Yeah. From my understanding, it would be separate for performance and payment. The builder's risk is really about the structure and materials.
Could you reinforce or remind me what a payment and performance bond is?
Yeah, I'm not as familiar with them. I don't write them very often, but I can tell you that it is typically used to ensure that the contractor is going to perform all activities in the contract as agreed to, and that if they don't, that there's money being put aside to make up for the lack of completion.
Yep. And the association usually pays that 2 or 3 or 4% of the total project amount for that bond. But we have the bonding capacity, and people have different bonding capacity. I don't have a $30 million bonding capacity, and I don't want one because I don't want to do a $30 million project. So everyone has different bonding capacity. Great conversation, great information. I learn something every time. And I've been around the industry for a long time, and I've owned condos, and it's just great to learn more and more from subject matter experts. So I really think, Tom, Daniel, once again, thank you for being on. We got one more question here, also. Yes, also, if the association does not pay subcontractors or suppliers, there's partial lien releases that we do to make sure that our suppliers are being paid, and we provide those every time we request payment. That's also very important. So good point, Dominic. So
yeah,
Dan,
Dominic's point is in the performance or payment bond. I think he was just expanding upon the definition.
Yep, I agree. Daniel, thank you. Tom, thank you. Looks like we're ending a little early. Great questions, great interaction. Some people had to drop off. Thanks for joining us. Peggy's going to send out the list of all of the personnel, all of the people that were on this call. She's going to send out the link to the video when we're ready. Tom, do you have anything else, or Dan, do you have anything else?
No, I'm good on my end. I wish everyone a wonderful weekend. Always nice to end a little early on a Friday, and hope everyone enjoys the beautiful weather we have before it starts getting too hot.
Yes, absolutely. Peggy, we'll let you close it out.
Okay, great. Yeah, thank you so much, everyone. CAMs and board members for getting on today and choosing our webinar. Tom, for your preparation. I know you did a lot to pull this together, and also Daniel for a panelist, and Rudy for moderating. I do have a few things coming up. I'm so excited. My next event, in-person event, and I hope the board members and CAMs in the Palm Beach County, Martin County area will join us next Tuesday at the Hurricane Huddle. We've got a board member panel, we've got a keynote speaker, and an industry panel, along with 20 vendors that are exhibiting. So that's going to be at the Palm Beach Hilton up by the International Airport from 9 a.m. to 3. If you haven't gotten a flyer, please email me. I'll send you one, but I will still be sending out more invites today and over the weekend. So that is May 19th, Tuesday, from 9 to 3. On May 21st, we've got Vinteum software coming in. They've got a feature on their software for board members for electronic voting. You want to hear everything about electronic voting and how they do it or how it can be done. Also, they have free demos, and that is going to be May 21st, and you don't want to miss that. On May 26th, I have the standing new monthly webinar called Coffee with the County. This one, because we're working on hurricane preparation, they're going to talk about pets and hurricanes, how to store your pets, what to do with them when a storm comes, not just hurricanes, but storms in general. So please join us for that. Also, they are going to have a booth that you can stop by and visit with them to talk about some of these topics at the Hurricane Huddle on May 19th. 5:29, we've got Dan Wasserstein, attorney, coming in. He's out of South Florida. He's going to talk to you about fining. So don't miss that. That is a Friday morning from 10 to 11:30 in the morning. And then I'm just going to mention the next upcoming construction summit I'm really excited about. I just booked every detail yesterday. It's going to be on June the 12th. It's with Clarkson and Varick. They're going to give a CEU class on elevator information, maintenance primarily. And then we've got attorney Ball Janet coming in. They are construction defect attorneys coming in to be on the panel. So I hope you can join us on these dates. I'll put them in my follow-up email from today, along with the sponsor sheet, as Rudy mentioned, and also the slides and the recording. So until then, have a great weekend. Enjoy your weekend, and thanks again.
Thank you, everyone.
Good job, Rudy. Thank you.
Thanks, everyone.
Good job, Tom.